From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. You're listening to the Macrocast. I'm Stratton, a partner here at Penta, joined as always by John Fagan and Brendan Walsh from Markets Policy Partners. And this week we have a couple of special guests. We have John Dick from Civic and Brai Odion-Esene, founder of SW4 Insights. We have lots to talk about, but I think, the breaking news right now is jobs report, and what a jobs report. What are we seeing in the numbers?
It was a huge surprise. Kind of all the leading up data kind of suggested, not that it was going to be a terrible one, but maybe 100,000. And it was 517,000. Part of that was government, but still the private was 443,000. And Brai, the only explanation I has is that Chelsea hired everybody because they're spending a lot.
I mean, we do have a lot of money to burn this month, so
it's not pretty fascinating how much money you have to burn. But the most of the hiring was in the private service sector. People are going back out and doing things. But most importantly, beyond the fact that there was a huge jobs number, we got a bunch of revisions for 2022, and most people thought that those revisions would be negative, and they weren't. We actually had a net positive revision for 2022. So in terms of the employment, the labor sector in America, it's pretty strong. But most fascinatingly, we didn't see a huge increase in wages. So we might be in that scenario where we have the Goldilocks, where we're still creating jobs, but inflation's not getting out of control. What do you guys see?
What about so they changed the data, right? There was some sort of adjustment that was made in the statistics. And what the way that markets react, obviously, you're seeing treasury yields jump, and this is and equities, although everybody's hoping that there's a soft landing, and the equity market has been positive and upbeat so far this year on expectations that perhaps we're going to avoid a recession entirely this year. This sort of feeds that narrative. But at the same time, it also sort of creates concern that the Fed might have more tightening to do. So, right. So we do see that sort of reflexive. Equities don't. The initial reaction, the knee-jerk reaction from equities is negative. But when you have, what tends to be when you see a number that's so outside of consensus like this, it does tend to get discounted by market participants. They start peering through, whether it's the adjustments or, and you begin to try to, find something in the underlying statistics that bring you back to, a trend kind of pattern in jobs. Most of the, surveys have shown, some resilience in the labor market, but not like a blowout in hiring. Exactly. So I think that there's the knee-jerk reaction aside in markets, there's going to be some discounting of what the emphasis, what the real significance of this number is.
Yeah, like the Nasdaq's down 2%, but it was up 3% yesterday. So you got to keep things in perspective.
Well, I'd have to imagine this gets revised next month, and probably downwards. I'd be shocked if it got revised upwards. So, definitely take this with a pinch of salt. But also, to the point Brendan made about wages not rising in kind, it also makes me think that, we saw the conference board release consumer confidence data this week, and consumer confidence is down, right? So I feel like, yes, people are finding jobs, but there's not a lot of confidence out there in the economy or economic prospects in terms of like the inflation issue and the high prices people are dealing with. Yeah. And if their wages and salaries not rising to match price increases, regardless of whether someone has a job or not, you're going to cut back on certain things if you're worried about the future, right? So
well, we're pretty lucky because we actually have a guy that does this for a living.
John,
what are you seeing?
Well, this is just like the Long Island iced tea of macroeconomic cocktails, right? It's like, the mix of signals is just crazy. when I was with you guys a couple of weeks ago, I mean, we knew that what the conference board was going to say, because we generally lead it a couple of weeks with the ESI, and it was down again we just had another reading on Wednesday. It was down slightly again, which, the head scratcher, I guess, at face value is that confidence in finding a new job fell over the last 2 weeks. Now, keep in mind that the way we track that is a forward-looking indicator. We're asking people, do they believe it's going to get harder or easier to find a job, right? And look, when you've got now 500,000 new people getting jobs, guess what? There's fewer jobs. It's going to get harder to find a job, right? And I think the conventional maybe theory there would be that, people are seeing like headlines of, these huge tech companies laying off 10,000, 20,000 people, but that's not affecting these, the service categories. And frankly, Microsoft laid off 10,000 people, but they'd hired 40,000 last year. So we're still like in the net, definitely in the black there.
Yeah. And so many of those layoffs are in like sales. It's not like programmers.
Right.
They're still hoarding those as much as
right, and HR and places like that, right? And so, but I think why we're seeing some softening in job optimism among consumers just may very well because they're like, look, there's fewer jobs open, and that's the thing. Now, the other side of the ESI, which is more on the spending and personal finance side, that fell a good bit. That fell almost 2 full points in the last 2 weeks. And we usually see that right around this time of the year because it's when the Christmas credit card bills show up and home heating costs. Heating costs are up, and so I'm not going to overreact to it because there's a bit of seasonality to that, but it also just makes a lot of sense. I mean, eventually inflation was going to grind away at all this stockpiled household savings people accrued over the last 2.5 years. And so, we're not by any means anywhere near the sort of ESI bottom we saw last June when sort of inflation was really shocking everybody and spooking them. But, it's tenuous, I would say, on the spending side. Consumers are cutting back on some staples in the grocery store, making some sacrifices here and there.
And you're seeing that in the earnings calls, things are doing fine, but, the consumer is pulling back, and small businesses are pulling back a little bit on spending. Not like the end of the world, but you're being cautious.
Sure. Well, and we're still seeing the shift toward experience or experience type of spending, and maybe these are people saying, look, I'm gonna cut back a bit right now, but because I want to plan a vacation this summer. I mean, we'll have to see. We're a little bit early to start gauging summer travel and vacation kind of things and concert sales and stuff like that are big ticket items in the summer, but
we got two big ones coming this summer. Probably the two biggest acts in the world are going out this summer, so that'll
tell me who. I don't know. I don't know who.
Yeah, who? I want to know.
Is this going to move the market? Is what the
question. So yesterday, Beyonce announced that she's traveling, and then Taylor Swift is also traveling this summer. Yeah.
Those are two names that even I know. Yeah. even I know those two names.
I'm surprised the markets didn't go up on that news.
Exactly.
That will drive a lot of sales. But yeah, it's such an amazing. Yeah, it's the social experiment we've been in for the last 3 years, an economic experiment of it all. But there's so many weird conflicting things. As I've joked with you guys before, not being an expert in finance to the extent you are, it's like, oh my gosh, there's this amazing job market number and the stock market just went way down. Like, wait, I thought that would be a good thing. But I mean, I'm starting to, you guys have taught me enough about that to understand it at this point, but the consumer, I think, is still pretty good. It's not great. There's going to be some ups and downs, and they do watch the news, and if it bleeds, it leads, and all that sort of stuff. So it's hard to separate the PR from the reality.
Yeah. But I kind of have this theory, and your data might support it. Like, we don't have an economy. We have like 10 economies. And they're uncorrelated. Like, housing's going down, but Disney World's going up. Like,
right, services.
And you can have some things not do well and some things do quite well, and they average out. So I think people get a little too caught up in whether we're in a recession or not, and it's more important to focus on each individual sector.
Right. Well, and incidentally, this week's ESI, the confidence in buying a new home, the outlook for buying a new home actually improved a bit.
Yeah.
Like I think this consumer feels like we kind of hit the bottom of that.
Yeah.
And so we may not skyrocket back up, but yeah.
And mortgage rates are, I think they're in the fives now, which is a big deal,
Yeah. Yeah. So it's an interesting mix. One other thing about jobs is we've been doing a lot of analysis on kind of job satisfaction, mobility intent. Like, am I looking for a new job? And, what's jumped off the page for me is the disparity between sort of job satisfaction among people who work in person in a physical location versus people who work fully remote. Mm-hmm. And job satisfaction and happiness among fully remote workers is significantly lower than people who are actually in person at work. Yeah, there's some like mental well-being, social elements to that. We published a study a couple of weeks ago about sort of how much friendships have been in decline over the last 3 years, like net loss of friends. And that a big part of that is I'm not going into the office and making friends, or there's other elements of that too, that maybe just relationships that fell off during quarantine and so on. But those people who are working, it's almost unconscious, right? It feels like, I have all this flexibility in my life, but it's weighing on them emotionally in other ways. But when we ask people sort of what are you looking for in a new job? The in-person workers say, I'm looking for more pay. The already at-home remote workers are looking for more flexibility. So, it's still not good enough for them yet. So good luck finding a job that pays you more, that's even more flexible than already letting you work at home all the time. But that's also, I think people who are maybe that could be influencing our job ESI numbers is that there's probably not a lot of better work out there anywhere for me. So I don't feel like I have a lot of mobility at the moment to get, everything I want out of my job. But no, this is interesting times.
And we saw some of that commentary, I think, from Chamber of Progress with some of the big tech layoffs, saying there are lots of tech jobs out there, just not in the big tech companies. And so you're gonna have job opportunities. They're just gonna look different from what you have now. And that's sort of what you have to roll with right now.
Yeah, I mean, gourmet lunches cooked for everybody in the company every day, and in-house masseuses and all that sort of stuff. That we've probably seen the end of those days for quite. Yeah.
Well, so back to our Long Island iced tea of economic news. Brendan, John, Brai, we had lots of central bank moves this week. John, do you want to kick us off with the Fed?
Yeah, the Fed was expected to downshift from 50 basis points to 25 basis points in their rate hiking campaign, and they did. And that was accompanied by I think it's fair to say, some mixed messages from Fed Chair Powell. Some would say, the critics would say, a little bit garbled. And the markets, because of that sort of Rorschach test kind of ink blot communication strategy that Fed Chair Powell put out there, the markets heard what they wanted to hear. Mm-hmm. And there was a great focus on the downshift itself, the more balanced commentary that Fed Chair Powell put out there about the economy. And, there was a little bit of I think from a market's perspective, perhaps sort of a gloss over his, commentary that there's still work to be done and rate hikes are going to continue. We see the biggest disparity in the markets right now, or one of the biggest disparities in the markets right now, is the Fed's insistence that they are nowhere near cutting rates, and they are going to continue hiking and hold rates high for an extended period of time until inflation is back in the box. And the markets are pricing in rate cuts as early as later this year. And that was, and Fed Chair Powell did not succeed in talking markets out of that expectation.
Yeah, I feel like that's a big theme right now, is like markets, it's like, we don't believe you.
Yeah, if you're getting your bluff called like that, that's not where the Fed wants to be necessarily.
Well, I think it's weird because on the one hand, he's staked out this position of like, jobs not done, we're going to be at this level for a while until we're reasonably confident that inflation is heading downwards. But then they also say that all the decisions are data dependent. So why telegraph months out what you think is going to happen when if meeting by meeting you look at the data you've had for that meeting and then decide? Just say that. Like don't predict or don't, because I feel like if they do have to do a climb down or change course, it makes it look like they folded or changed their minds, where no, it's just the data came in saying something and then they react to the data. So I would just stick to the data dependent line and not try and, jawbone the market by saying, oh no, we're gonna be at this point for a long time. Because if like 2 months from now we get really, really good inflation data that shows a faster decline than expected, they have to react to it, right? Like, so it's like, I don't understand this determination to like predict what they're gonna do when they could just like stay data dependent and leave it at that.
Yeah, and that really feeds the perception in the markets that the Fed is kind of overstating the case, right? They're doing a bit of performative hawkishness, right? And the dots are here because it's the old, as the Kentucky windage, right? If you've got the wind blowing, you want to aim a little bit to the other side of the target if you're really going to hit it. And so that I think is fueling some of the perception in the market that the Fed is sort of not market participants sort of watching what they do rather than what they say.
Yeah.
Well, and so what's the corollary story happening elsewhere? I mean, we had rate hikes at Bank of England, at ECB. How are markets reacting to those? Is it a similar story? Brai, what are you hearing or what are you seeing?
Well, I mean, I think the Bank of England made it explicitly clear that they were going to pause for a little bit and assess how things stand. I think also the UK is in a very different situation to the United States in that the economic risks are a lot higher.
Yeah.
Odds of recession are a lot higher. And so I think it's prudent central banking for them to say, you know what, we'll kind of hold position and ensure that we don't add to existing problems that the country is facing and just kind of get a sense of where things proceed from here. So I think they've been very explicit that they're gonna sort of hold and see which way things go. I think the country is dealing with enough problems as it is without them adding to it by hiking rates to an untenable degree.
Yeah, and the ECB is essentially, they're forging ahead, and expectation is for more rate hikes. But the anticipation is that if the Fed is tapering and pausing their rate hike campaign over the next couple of meetings, that gives a lot of leeway to other global central banks to follow suit. And it's, without their currencies. Remember last year, one of the problems was the Fed was just so aggressive that other currencies were falling out of bed, and you could see those accidents in the market happening in the UK. And you could see some real, shivers running down the spines of traders looking at, Italian bonds. Some of these pain points that have persisted in markets coming back to the fore, and the end of the Fed is still global, the global central bank, and it's the fact that it's the peak rates are at least in sight here takes a lot of pressure off other central banks. And even if the inflation numbers in the EU are less encouraging than they are in the US, and there's an expectation that the ECB has still further to go, that isn't mirrored by the same kind of market stress that we saw last year.
One last question, taking us back to the jobs report and the Fed, and then we'll take a break. I mean, speaking of mixed economic messages, what should people be thinking about, with the Fed strategy going forward in the jobs report? We have big jobs numbers, but as y'all noted, wages, aren't red hot, at least in this last report. So what does that mean for future rate hikes?
Yeah, Brai, what do you think? I mean, the market had priced in one more 25, and then we're going to start cutting. So I think that narrative is changed after today.
Yeah, I still think they do at least one more. It's just surreal to me that we're in a world now where a strong jobs report is bad news. It's just, I'm still like having the hard time wrapping my head around. Like, no, man, I still remember. Like, I'm a child of the 2008 crisis, right?
Yeah.
So a jobs report this strong would have like people dancing in the streets and be like mission accomplished. So this is a surreal moment, but I do think it is helpful that we're not seeing a complementary jump in wages. I do think, and I personally disagree with this approach, but I do think the Fed is looking at wage inflation as one of its gauges of how things are going in its fight to bring prices down, or the pace of price increases down. So I don't think this report would give them cause for concern. I think I'd be more worried if the plus 517 jump in jobs was matched by, like plus
Exactly.
plus 6% or plus 7% increase in wages.
This literally was a Goldilocks number. The economy is still doing fine, but we're not seeing wage spirals.
And I think it links to the comment you made, Brendan, about it's not one economy. And I think in the same way it's not one economy, it's not one jobs market.
I totally agree.
Yeah.
Right? We look at it and we say, oh, this many jobs are added, but we didn't all hire 500,000 investment bankers, right? Or 500,000, right? Or 500,000 consultants. So not everyone is getting paid the same amount, right?
Yeah.
So I think
we're still doing catch up on the leisure and hospitality.
Exactly.
It got shut down for 2 years.
Yeah, exactly. It's still lagging the pre-pandemic levels. So I think based on that, I don't think the Fed will look at this and think, oh, we need to return.
And also, prime age participation rate went up. That's huge. We need people to keep coming back into we don't have enough workers. We need people. We talked about it last week. We need people to come back to the labor market, and that is starting to happen, which is tremendous.
Yeah, I mean, the participation rate has barely budged for how many years now, right?
Yeah.
We've been stuck in the mid-60s for a long time now. And so I think based on that as well, I don't view this as a report that would push the Fed to aggressively start hiking rates again.
All right, great. We're going to take a short break. And when we come back, we're going to discuss earnings and start talking about everybody's favorite topic in DC, the debt ceiling.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
All right, and we're back with the Macrocast. Let's jump in and talk earnings. We had some earnings come out last week, but a lot of big earnings this week. John, what are we seeing across different sectors?
Yeah, this week was just a murderer's row of big tech companies, and that was the story for third quarter earnings was just dismal tech results, and markets were getting a little maybe a little complacent. You got a good number from Netflix, you got solid Tesla earnings, and then Microsoft wasn't great, but it was okay. And then earlier this week, you got Meta, Facebook, still call it Facebook, knocking it out of the park. And so that led, that got everybody pretty excited about, a big tech rally. Tech stocks are up a ton this year already. And then last night we got Amazon
20%.
Yeah, absolutely. And then last night we got some kind of not so great, disappointing, not real clangers, but a little bit soft on the demand side from Apple. We saw the same kind of story from Amazon. And when it came to Google's ad results, it wasn't great shakes. So these are not collapsing by any stretch of the imagination. They're down a little bit overnight. And this is, as you said, Stratton, this is after really, gaudy kind of double digit gains so far this year. And, that's coming off a pretty lousy year last year. So, the contextualizing this price action is important, but essentially we don't have the same story as last quarter, which was dramatic and startling deterioration in big tech profits and earnings, and this is we're in this phase where earnings across the board have sort of neither confirmed nor denied that the U.S. economy is going into recession, and that's mixed bag is good enough when you have other positive atmospherics like inflation rolling over and going in the right direction, and the Fed beginning to finish off their rate hike cycle. So stocks have had a great year so far, and earnings season hasn't knocked them off their line yet.
Yeah, and you had a terrible year last year, so everything's relative,
Well, it seems like the one sector that's definitely throwing a ticker tape parade, though, is oil and gas, right?
That was the bright spot last year. And so one of the things that we've seen this week, which is pretty notable actually in price action, is the, oil prices have just declined to, participate in this big risk asset rally. And, whether you're talking about the excitement of when the oil bulls have really gotten, the bit in their teeth last year at certain points, with a disruption in supply from around Russia's invasion of Ukraine, OPEC cutting supply, and then the story was supposed to, and then that story really came off, and this year the big upside impetus was supposed to be around China's reopening. Well, we've seen oil just kind of going sideways, languishing near, recent lows, and being, unable to get any sort of upside. That's great from, if you're the Biden administration, you're the consumer, at the pump. This is really good news. It feeds that sort of Goldilocks narrative that's taken hold in markets right now. But it's certainly worth noting.
Well, I thought that was that reminded me that was an interesting one out of Starbucks earnings, right? They pointed most of their misses and their targets to the closures because of the explosion of COVID in China.
Yeah, and this is where the China bulls are figuring that this exit wave that was just bound to happen when they threw open the restrictions and basically just turned COVID zero on its head in a very short period of time. There was always going to be a big spike in cases. And, the expectation is that once that plays through, maybe by early spring, perhaps China is going to be back in business in a really serious way. But, we're still in this kind of, this difficult period of getting through that exit wave. On the other side of it, we've seen these in recent years. We've seen these stories of China stimulus before, and it's always been more headline than result. And we're wary of the same, a repeat. Next week we've got Chinese credit data coming out. Credit data is usually where you see, just how big a push the government is making, how concerted an effort they're making to reflate their economy. And so it'll be interesting to see how those numbers stack up against expectations.
Let's shift gears to DC from Wall Street. So obviously we've seen some progress in the debt ceiling negotiations. McCarthy and President Biden had a big summit, but I think still a lot of details not out there on the table. Brai, do you want to kick us off and tell us where we're at and what you're thinking about and the look ahead?
Well, so it seems like, we had an initial meeting between Leader McCarthy and President Biden this week. It seemed to have gone cordially, but again, these things always start off cordial before the gloves come off. So it seemed like, I think, just to give folks a quick recap, when discussions around raising the debt ceiling first started, I think Democrats staked out a line about they want a clean debt limit increase, while House Republicans wanted to combine any negotiations to raise the debt limit with talks around spending reductions, especially in non-defense spending. And I think while the White House initially said, no, let's do a clean debt limit increase, and then we can talk about reducing spending, based on what came out of the meeting between Biden and McCarthy, it does appear that we will get some sort of negotiating where Biden might contemplate some spending reductions in exchange for raising the debt limit. The question is, will Democrats in both the House and Senate go along with that? And will be able to enforce some discipline? And also the question is then for McCarthy, what sort of deal can he strike that will be acceptable to, I guess, for lack of a better word, the right-wing elements of his party who want deep cuts to be made. So I think it's still too early to predict which direction it will go. As someone who covered this when we almost got to the brink in 2011, I've yet to see any flamethrowers to the extent that of cruises and whatnot who were really detrimental to talks in the past. So far, it seems like everyone is letting the two leaders talk and hash it out. But I'm curious to see the sort of role that the Senate plays. McConnell so far has seemed to yielded the floor to McCarthy to take the lead on talks. You imagine eventually, though, the Senate Republicans will want to have a say in how things stand. Obviously, Chuck Schumer will want to have a say as well. So yes, I think, no alarm bells are ringing just yet, but time will tell.
Yeah. I just get worried, irrelevant of what people want. When you only have a seat majority, it's just very difficult to corral people. You only have a couple people that can blow things up. So I think we end up getting it done, but I think it's going to be a lot scarier even than it was back in what it was 2011.
Right. Isn't that sort of the risk? Is we've been through this and people are sort of numb to it and they think, well, it's going to get dumb.
Well, John has a good story, from his time at the Treasury.
Yeah, during one of these episodes, we got a message when I was running the markets analysis unit at Treasury. They had word came down from Capitol Hill, the Democrat side, that wondering why markets weren't taking the debt ceiling risk more seriously, and kind of making the point that it would be helpful if markets were selling off a little bit more, expressing a little more fear, that would focus minds on the other side, give them a sense of the consequences and potential consequences of this. And what the answer to that is, markets just have seen this movie before. It's The Boy Who Cried Wolf, right? You can't orient your portfolio around debt ceiling risk if you've just seen again and again. It's a lot of headlines, and at the 11th hour they get they come to some sort of solution, and that, so almost by definition, based on past experience, markets are going to be on the side of complacency, on the side of assuming once again an 11th hour fix.
So I'm going to ask sort of the $1 trillion question here, Brian. Maybe you can take this one. Is if you're taking defense spending off the table, and we've also seen taking Social Security and Medicare off the table, like do you either
what exactly can you cut?
Right. And I guess my question is, do you lower your ambition for how much you can cut? Right. Like maybe you can cut tens of billions, but you're not cutting hundreds of billions. Or do those things actually get back in play?
Well, so, and you're right, and this is why this is so frustrating, because you can't say I want to cut spending, but then have like sacred cows that will not be touched, right? Like you can't have it both ways. And so I think what ends up happening is maybe the word cut is not the right adjective. Maybe they just freeze spending, right? So they say that we want to freeze spending in 2022 levels, right? And then so it's not going up, but it's not going down. I think that might be more realistic than finding actual cuts somewhere. So I think I could be mistaken. I think that might be what McCarthy's opening gambit is to freeze spending at last year's levels, rather than adding to them. So yeah, I think that would make more sense. Because to your point, once you take Social Security, Medicare, Medicaid, and defense off the table, where are you going to find trillions of cuts? I just don't see that being possible. So I think freezing makes more sense than cutting.
No, that's a great point, because then I guess you can always take a CBO projection and say, compared to baseline 10 years out, we've saved $800 billion or whatever the number might be.
Exactly.
That's a really important point, because we spent so much during the pandemic that just from optics, we're going to spend less. So you can kind of take your win by just, not spending $1 trillion
right. The White House had a moment on that last year, didn't they? Where it's like, oh, the deficit this year dropped by $1 trillion.
Yeah. That was pretty easy.
Yeah. Well, guys, what's next? What should we be looking out for next week and the rest of the month?
We have a fairly quiet week next week in terms of the data. I was actually just looking at it.
We got U.S. consumer sentiment. We mentioned China credit. We also get China inflation, EU retail sales, German industrial production, Australian inflation, State of the Union speech. Secretary of State Blinken was supposed to go to China, but the balloon has preempted his trip. I think the headline said he just canceled it or postponed it because of the spy balloon.
I mean, if I wanted to make a case for cutting defense spending, the fact that we can't guard against a hot air balloon, question, what are we spending money on, right? Like foiled by a hot air balloon, all these radars, and a hot air balloon can just...
We're just going to let it go. It's crazy.
It's mind-boggling to me. I'm like...
But also on the flip side, if you're China, like, is this 1912?
No, I mean, I say I'm pretty sure balloons? Pretty sure they did this in the Franco-Prussian War.
Exactly.
This was the innovative technology then.
Did they not think we would see it?
I mean, maybe they don't care. Maybe to the point that I think a news article made, shooting it down might be dangerous for those below. So maybe that's they found us.
But also, like, you can just go on Google Earth and see the same thing that this stupid balloon is showing you.
It's
All right. I can honestly say I didn't expect us to end on balloons, but I'm happy. All right. Thanks for listening to the Macrocast. I'm Stratton with Pinta, and thanks to John and Brendan of Markets Policy Partners, as always, for hosting. And John and Brai, our special guests, for joining us today. Have a great weekend, everyone.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.